Growing your money. The power of investing. Investing is about more than just making money. It's a strategic approach to building wealth over time. When you invest, you're essentially putting your money to work, allowing it to grow and multiply. This can help you achieve financial goals that might seem out of reach with just regular savings. It's about securing your financial future. Whether you're planning for retirement, saving for your children's education, or looking to buy a home, investing can provide the financial foundation you need. By making informed investment choices, you can create a safety net that ensures you and your loved ones are taken care of. It's about making your money work for you, so you can achieve your dreams. Imagine being able to travel the world, start your own business, or simply enjoy a comfortable lifestyle without financial stress. Investing can turn these dreams into reality by generating passive income and growing your wealth over time. One of the simplest and most effective ways to invest is in the stock market, and a great place to start is the S&P 500. The S&P 500 is an index that tracks the performance of 500 of the largest publicly traded companies in the United States. By investing in this index, you gain exposure to a diverse range of industries and companies, which can help mitigate risk and increase your chances of earning a positive return. Historically, the S&P 500 has delivered strong returns, averaging about 10% annually over the long term. This makes it a powerful tool for wealth creation. By staying invested and being patient, you can ride out market fluctuations and benefit from the overall growth of the economy. The stock market can seem intimidating, especially for beginners. With all the financial jargon and market fluctuations, it's easy to feel overwhelmed. But remember, every successful investor started somewhere. The key is to educate yourself, start small, and gradually build your confidence and knowledge. Investing in the S&P 500 is like buying a small piece of America's largest companies. When you invest in this index, you're essentially becoming a shareholder in companies like Apple, Microsoft, and Amazon. This means you get to share in their profits and growth, which can significantly boost your own financial portfolio. The ease of investing in the S&P 500 is another major benefit. With numerous index funds and ETFs available, you can start investing with minimal effort and low costs. These funds are managed by professionals, allowing you to benefit from their expertise without having to pick individual stocks. When these companies do well, so do you. Over the long term, the stock market has historically provided strong returns, making it a powerful tool for wealth creation. By staying invested and being patient, you can ride out market fluctuations and benefit from the overall growth of the economy. So start investing today and take control of your financial future. The S&P 500 has a long and impressive track record. Since its inception in 1926, it has been a benchmark for the performance of the U.S. stock market. The index includes 500 of the largest companies listed on stock exchanges in the United States, representing a broad cross-section of industries and sectors. Over the past 90 years, it has delivered an average annual return of around 10%. This impressive return is a testament to the resilience and growth potential of the U.S. economy. The S&P 500 has weathered numerous economic downturns, wars, and financial crises, yet it has consistently bounced back and continued to grow. For example, during the Great Depression, the S&P 500 experienced significant declines, but it eventually recovered and surged during the post-World War II economic boom. Similarly, during the 2008 financial crisis, the index dropped sharply but rebounded strongly in the following years, reaching new highs. This means that your money has the potential to grow significantly over time. The power of compounding plays a crucial role in this growth. By reinvesting dividends and allowing your investment to grow over the long term, you can take advantage of the exponential growth that compounding offers. Even small, regular investments can grow into substantial sums given enough time. Of course, past performance is not a guarantee of future returns. The stock market is inherently volatile, and there are always risks involved in investing. Economic conditions, political events, and changes in market sentiment can all impact the performance of the S&P 500. It's important to be aware of these risks and to have a well-thought-out investment strategy. But the S&P 500's consistent growth over decades makes it a compelling option for long-term investors. By staying invested through market ups and downs, investors can potentially benefit from the overall upward trend of the market. Diversification within the index also helps to mitigate some of the risks associated with individual stocks. It's important to remember that investing is a marathon, not a sprint. Patience and discipline are key to successful investing. By focusing on long-term goals and maintaining a diversified portfolio, investors can navigate the inevitable market fluctuations and work towards achieving their financial objectives. The S&P 500, with its history of strong returns, can be a valuable component of a long-term investment strategy. Don't put all your eggs in one basket. That's the golden rule of investing. The S&P 500 includes 500 of the largest companies in the United States, spread across various sectors. This diversification helps reduce risk by spreading investments across different industries. When you invest in the S&P 500, you're not betting on just one company or industry. You're investing in the overall strength and growth of the American economy, which can protect against market volatility. Investing always comes with risks. It's important to understand these risks and manage them effectively. Diversification, as mentioned earlier, is one way to reduce risk. Index funds and ETFs are popular choices for diversification. When choosing the right one, consider your investment goals, fees, and the fund's performance history. Remember, never invest money you can't afford to lose. Starting to invest can be daunting, but it doesn't have to be. Begin by setting clear financial goals. Ask yourself, what are you investing for? Whether it's for retirement, buying a home, or simply growing your wealth, having a clear objective will guide your investment decisions. Next, determine how much you can afford to invest. It's crucial to only invest money that you can afford to lose, especially if you're just starting out. Take a close look at your finances, create a budget, and see what amount you can comfortably allocate towards investing without affecting your daily needs or emergency savings. Once you have your goals and budget in place, choose a strategy that aligns with your risk tolerance. If you're more risk-averse, you might prefer safer investments like bonds or index funds. If you're comfortable with higher risk for potentially higher returns, individual stocks or cryptocurrencies might be more appealing. Consider consulting with a financial advisor to help you make informed decisions. A professional can provide personalized advice based on your financial situation and goals, helping you to create a balanced and diversified portfolio. Remember, the key to successful investing is consistency and patience. Start with small, regular contributions, and let the power of compound interest work in your favor over time. Don't be discouraged by market fluctuations. Stay the course, and keep your long-term goals in mind. With careful planning and a disciplined approach, you can start your investment journey with confidence and work towards achieving your financial dreams. Dividends are a portion of a company's earnings distributed to shareholders. They can provide a steady income stream and contribute to the overall return on your investment. Many companies in the S&P 500 pay dividends, making it an attractive option for income-focused investors. When you invest in dividend-paying stocks, you receive regular payments, typically on a quarterly basis. These payments can be reinvested to purchase more shares, thereby compounding your returns over time. This strategy, known as dividend reinvestment, can significantly boost your investment growth. Moreover, dividends can offer a level of stability in your portfolio. Even during market downturns, companies with strong fundamentals often continue paying dividends, providing a cushion against market volatility. This makes dividend-paying stocks a popular choice for conservative investors looking for both income and growth. It's important to note that not all companies pay dividends. Typically, more established companies with stable earnings are the ones that distribute dividends. These companies are often in mature industries where the potential for rapid growth is lower, but the capability to generate consistent profits is higher. By including dividend-paying stocks in your portfolio, you can enjoy a blend of income and potential capital appreciation. This dual benefit makes dividends a powerful tool in building long-term wealth. So whether you're a beginner or an experienced investor, considering the role of dividends in your investment strategy can help you achieve a balanced and resilient portfolio. Understanding the tax implications of your investments is crucial. Different types of investments are taxed differently, and knowing how these taxes work can help you maximize your after-tax returns. For instance, dividends and capital gains are often subject to different tax rates. Qualified dividends are typically taxed at a lower rate than ordinary income, while non-qualified dividends are taxed at your regular income tax rate. It's essential to know which type of dividends your investments are generating to plan effectively. Capital gains, on the other hand, are profits from the sale of an asset. If you hold an investment for more than a year, it is considered a long-term capital gain, and is usually taxed at a lower rate than short-term capital gains, which are taxed as ordinary income. This distinction can significantly impact your net returns. Additionally, tax-advantaged accounts like IRAs and 401(k)s can help you defer or even avoid taxes on your investment gains. By contributing to these accounts, you can grow your investments tax-free or tax-deferred, which can substantially enhance your long-term wealth. It's also important to consider the impact of state and local taxes on your investment returns. Each state has its own tax laws, and some states do not tax capital gains or dividends at all. Understanding your local tax environment can help you make more informed investment decisions. Finally, tax loss harvesting is a strategy you can use to offset gains with losses, thereby reducing your taxable income. By strategically selling losing investments, you can balance out the taxes owed on your gains, optimizing your overall tax situation. In summary, being aware of the tax implications of your investments and planning accordingly can help you keep more of your hard-earned money. Consult with a tax advisor to ensure you're making the most tax-efficient investment decisions. By doing so, you can maximize your after-tax returns and build a more robust financial future. Investing in the S&P 500 is easy and affordable, thanks to low-cost index funds and ETFs. These financial instruments have revolutionized the way people invest by providing a simple, cost-effective way to gain exposure to the stock market. Unlike individual stocks, which require extensive research and monitoring, index funds and ETFs offer a hands-off approach. They are designed to replicate the performance of the S&P 500, a benchmark index that includes 500 of the largest publicly traded companies in the United States. This means that by investing in an S&P 500 index fund or ETF, you are essentially buying a small piece of each of these 500 companies. These investment vehicles track the performance of the S&P 500, allowing you to own a piece of all 500 companies with a single investment. This diversification significantly reduces risk compared to investing in individual stocks. If one company underperforms, it has a minimal impact on your overall investment because the other companies in the index can offset the loss. This makes index funds and ETFs an attractive option for both novice and experienced investors. Additionally, the fees associated with these funds are typically much lower than those of actively managed mutual funds, making them a cost-effective choice for long-term investors. Whether you're a seasoned investor or just starting, the S&P 500 is a solid foundation for any portfolio. For beginners, it offers a straightforward way to start investing without needing to pick individual stocks. For experienced investors, it provides a reliable core holding that can be complemented with other investments to achieve a balanced portfolio. The S&P 500 has a long history of delivering strong returns, making it a popular choice for those looking to build wealth over time. By consistently investing in an S&P 500 index fund or ETF, you can take advantage of the market's growth potential while minimizing risk. It offers a simple and effective way to grow your wealth over the long term. The power of compounding returns means that your investment can grow exponentially over time. By reinvesting dividends and staying invested through market ups and downs, you can maximize your returns. It's important to remember that investing in the stock market is a long-term commitment. While there may be short-term volatility, the overall trend of the market has historically been upward. This makes the S&P 500 an ideal choice for those looking to build a nest egg for retirement or other long-term financial goals. Remember, the key to successful investing is to start early, stay invested, and let the power of compound interest work its magic. The earlier you start investing, the more time your money has to grow. Even small, regular contributions can add up significantly over time. By staying invested and not trying to time the market, you can avoid the pitfalls of emotional investing and take advantage of the market's long-term growth. Compound interest is a powerful force that can turn modest investments into substantial wealth. So take the first step today and start investing in the S&P 500 to secure your financial future.